Good morning. I'm Vince Lancy. We're going to do a take two on this. I'm having some technical difficulties, so I may drop in and out. I apologize in advance. CME abruptly halted trading in all metals and natural gas contracts yesterday afternoon due to technical issues, disrupting futures and options markets tied to gold, silver, and copper and natural gas. The outage briefly impaired global price discovery, sending spot gold lower and silver lower before partial reopening began in natural gas futures, and then everything else opened up in order. We will address that in the charting section today, as it is a little bit more than suspicious if you ask us. Suffice to say, there are rumors circulating around about why this would happen, how it has to do with expiration, and people are talking about COMEX collapse. And other than COMEX collapsing, the rumors are founded. I believe that they're well founded. Look, when you're so close to these are circumstances that we're looking at right here. When you're so close to expiration, uh, when you have a large silver open interest, unnaturally large for this expiration, that hasn't been matched up yet, the need to match longs and shorts for delivery comes up very stressfully. And the difficulty in keeping a lid on prices when there are buyers who wish to take delivery and cannot be dissuaded otherwise, and no one wants to stand for delivery. So, what do? You stop the market, you match up buyers with sellers, you assuage fears of metal being available, you buy time with the less patient buyers. We'll get it to you next month, and you resume trading back and knock it down. That is, we contend, what happened yesterday. That is what happened on Black Friday. That is what happened yesterday. And it's basically a repeat of the same thing. How do we know that? We don't. But I've been on these conversations. I've been on the conversation where it's expiration and the exchange is trying to keep an orderly market, and they're trying to match up orders and they can't match up. There's 10 buys and there's five sellers. Like, well, I have five buys, and you're searching around for sellers, and you start calling your banks and you say, do you want to sell? Do you want to sell? Do you want to make delivery? No, 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 no. You shut the market. You call the participants and you say, you'll get it in 30 days. And then the market participant that had been buying, anticipating delivery, stops buying, and then the sellers come in and they push the market down. Now, am I 100% right on this? No. Is it speculation? No, it's conjecture. I've been on these calls. You're sitting on a desk and you go to the exchange. I've gone to the exchange and said, guys, I'm long a natural gas. I don't need to be. It's a mistake. Can you find a buyer for me? I don't want to make delivery. And so the guy on the desk picks up the phone and goes, hey, Vital, yeah, I got a guy here who's got a stray natural gas contract. Can you take it off his hands? Because he can't make delivery. Sure. Boom, click, Vince, you're done. So that's what happens. And I'm describing it like it's routine. It is routine for onesies and twosies. Not when half the exchange says I want to take delivery and the other half the exchange says I don't want to take delivery. It's very dangerous shit. And it's a sign, as we have said, as we have contended, that they no longer care about price rises. They only care about the speed of the price rise. And it's a sign of a broken futures market. That's it. And we'll get into the chart and what it did to the market. Of course, it knocked it down. But the actual main story, well, that was the main story. But the main story is JP Morgan sees 9,300. Oh, I'm really challenged today technologically. Bear with me, guys. JP Morgan revises its long-term gold pricing assumptions across the North American mining sector using a five-component framework tied to cost support, allocation shifts, and reserve dynamics. Scenario analysis, interestingly enough, seems to bury the lead and suggests gold equilibrium levels between 5,900 and 9,300 per ounce under varying monetary regime outcomes, with implications for institutional positioning and producer valuation. Now, JP Morgan's latest mining report does more than re-rate producers. It quietly outlines a framework for how high gold may need to rise under a changing currency regime, including this 9,300 scenario tied to full dollar backing. Now, we would say that the implications for this, the story starts out talking about miners, but the lead is buried about how high gold could go. But then when you bring it all back, they're basically saying it's safe to buy miners now. They're raising the floor. They don't think gold goes below 4,500. That's what they're saying. And you know what? If gold doesn't go below 4,500, then they're telling their clients, That with a price of 4,500, what price would you buy these miners at? And the same thing is happening with silver, folks. It's happening. Big implications for miners. And I think when you think about what people like Rick Rule have done, they've been selling their physical and adding to miners. This doesn't really contradict that at all. It's pretty interesting. Anyway, that story was sent out. Special JP Morgan sees 9,300 gold peak in the monetary reset. We'll skip the other stuff for fear of a glitch, and let's go right to the chart. This is a 15-minute chart for silver. I'm going to walk you through what happened. At 1 o'clock, the market cracks a little bit. At 1:15, the market starts to really crack. At 1:30, right here, they announce, after a 15-minute drop, they announce at 1:30, and then the market proceeds to sell off. What I described, if what I described is correct, then this behavior ties to it. I've been there. Onesies and twosies, not hundredsies and thousandsies, for lack of a better word. So China opens up and China proceeds to be bid again because there are still people who haven't gotten the message over there who say, I want the silver. They want the silver. Everybody wants the silver now. And if you're offering to sell it, then they're going to buy it from you. And moving forward, the silver gets bid, it gets bought again, and then somebody gets the message out to them, relax, it's okay, and then the market proceeds to sell off. We're in a range. JP Morgan has set the floor at 70, and JP Morgan is telling you that the ceiling is around 90. That's it. 88 was my level yesterday. I said get short at 88 or get short at 110. So I guess 88's the level, or more like 90 if you can stomach another $2 of losses. Anyway, so it feels like we're in a very, very wide range. It's a recipe for selling volatility or a recipe for scalping gamma if you're long volatility. And it's a recipe to start buying miners because we all know why miners are cheap. But now we have the catalyst. The catalyst is silver's probably not going to go below 70 for some time. And it may not go above 90, but that's not the point. The point is the banks are now going to raise their guidance on silver price. I'm Vince. Have a great day. Oh, I'm sorry. Let's do the markets. Gold is up $20 and silver is down $2.25. Amazing, right? Well, that's what happens when you have an exchange that's under pressure to make delivery from people that don't want to make delivery. You slow things down, you knock it on its ass a little bit, and then everybody catches their breath and they move forward. Otherwise, why would gold be up $20 today? Right? Copper down barely a penny. The problem is in silver, folks. The problem is in silver. Platinum down $4. Palladium down $64. Okay, maybe palladium's got a problem too. But if you look at the markets, nothing really warrants these types of move. The data today is jobless openings, and tomorrow is PPI. I'm Vince. Have a great day. Thank you for sticking with us.